You want 4 carriers because you don't want a situation where you're riding away from one carrier just so you can get commissions from another one. Contracts are everything. You're an individual, you're personally producing, you don't have a big team, you don't even need to think about that. The conversation changes from being a bunch of sales tactics and trying to finesse the consumer to really understanding them and guiding them in the right way. All right, you guys, so today I'm gonna have a conversation for all you new final expense agents that are trying to get into the business, trying to figure this business out. This is actually how Rita and I first initially met. We had final expense agencies. I want to declare we have no interest in contracts or anything that we're going to go over. So all of this is just pure game that I've learned from working with hundreds of advertisers that are consuming media, seeing their business operations, seeing how things actually work in this business, and also from my own personal experience. There's 3 things that everybody needs to be mindful of, okay? The first thing is contracts. This is the first thing that everybody needs to be mindful of, is where your contracts are at. Second thing is going to be underwriting. And the third thing is going to be your CPA. And these are the 3 things. If you can master these things, you will have a fantastic business and you'll be able to take care of a lot of families and help a lot of people. So when I talk about contracts, let me dive into that a little bit deeper. So when I'm talking about contracts, I'm talking about the actual contract levels that you have with all the different carriers that you're selling through, okay? This matters. You have level benefits, you have graded benefits, you have modified benefits, you have guaranteed issue plans. Like, understanding all of these different types of products that you're selling really, really matters. So these contracts are everything. Now, you hear some people talk about high comp levels, right? You're an individual, you're personally producing, you don't have a big team, you don't even need to think about that. Now, a healthy contract for anybody that's getting started, that's operating independently, that can go to get any contract off the street, you should be targeting no less than 120%, okay? That's the minimum that you need to shoot for. If you're personally producing, you have to have 120% on your go-to level carrier, okay? Your go-to level carrier needs to be at least at 120. Now, just because you're at 120 with a carrier doesn't mean you're gonna be at 120 with all the carriers, right? Some carriers, you may be at 115 with them. Some carriers, especially guaranteed issue, you may be less than 100% on that business. And this is kind of where it leads us to our next point of the underwriting, okay? You need to understand underwriting because this is what's going to dictate what the consumer qualifies for and who's going to be able to be the best carrier for that product. So you need to pursue the contracts, and when you pursue the contracts, you don't want to get contracted with every carrier, you guys. That's not the goal here. You want to have no more than maybe 4, okay? Back when we were selling, we had a core 4, okay? There was a core 4 carriers. And every good business that's really selling final expense, they don't need more than 4 carriers. Because what ends up happening, and this is something that a lot of people experience in the business, is they have contracts with 10 plus carriers. They're writing business with all those different carriers for different things. But what they're really doing is they're prolonging the time that it's going to take for them to be able to pay down that debt that has racked up from the business that has fallen off the books, okay? Persistency is everything. So the truth of the matter is you only want 4 carriers because you don't want a situation where you're riding away from one carrier just so you can get commissions from another one and neglect the fact that you have a debit balance here that you have to be able to reconcile and take care of, okay? You're gonna have to make sure that you stay on top of that. And the best way to stay on top of that is to continue to write new business and make sure that you're consistently hitting that pace of production where you're always having good business flow. Now, with your core 4, for us, back when we were selling, it's definitely not the same now. You know, use this information from, it's probably 5+ years old since any of this stuff has probably been really relevant, but some of these carriers still exist, probably under different brands and different names now. But for us, when we were selling, our first carrier was a carrier called Prosperity. Recently, I think they've been acquired by American Amicable. They now own Prosperity. You could definitely see if they're still an option, because if they are, they were a great carrier. The number one reason why we used them is because they pretty much took a lot of health conditions, and we didn't run into situations where they would cut comp because a consumer went from level benefit to graded or modified. We were able to keep a consistent comp level across the products that we were able to write with them, which was very, very good. And they were pretty ambiguous to pretty much all health conditions, which we wanted, right? So this was our go-to carrier. Roughly with Prosperity, we would write 40% of our business here, okay? 40% would go to Prosperity. Now, the next carrier that we had would be a carrier in our lineup that was good for a lot of respiratory issues, okay? A lot of the consumers that we work with have respiratory issues, whether that be COPD, emphysema, whatever that may look like, and it shows up in their medication history, it shows up in the use of inhalers, all that type of stuff. And we would have another carrier in the lineup called Liberty Bankers Life, okay? LBL for sure. But they were a great secondary carrier for specifically those consumers that had respiratory issues, as well as they were a great carrier for diabetes. And they had a great telesale process. Now for us, we were selling all over the phone. Most of you guys are selling over the phone, and you want to make sure that every carrier that's in your lineup is telesales enabled, okay? You got to be able to have telesales enabled contracts where you could call in, either do a third-party verification on the phone, and you do all voice signatures. No e-signatures, you guys. We want to stay away from e-signatures. They do not help the process at all. And then we had another carrier in the lineup, and this carrier was for different uses, okay? And this carrier for us was Americo. Americo was a great carrier because they were great for psychological disorders. Okay, so people that had, schizophrenia, bipolar, all those type of psychological disorders, especially they had good programs for smokers as well, where if they wanted to quit, they'll give them non-smoker rates for the first couple of years, and then if they didn't, their rates would be adjusted. But it was good for those people that did want to benefit from that and get access to those benefits very, very early. So this is Americo. And then the last carrier in our mix, which everybody must have, which is a guaranteed issue carrier. You gotta have a guaranteed issue carrier in the mix. For us, it was AIG. I think now they're branded under Core Bridge. So AIG was our guaranteed issue carrier that we went with. Now, breaking down the rest of this split, maybe 15% of the business would go to Liberty Bankers, right? Probably another 15% of the business would go to Americo. And then that remaining 30%, you guys, would all be guaranteed issue, okay? And this is what everybody has to be mindful of. You're not gonna have a perfect mix where all your customers are all going to be your level go-to carrier, where you're getting the best comps. That's not gonna be the situation. Most of it's gonna blend out to be like this, where you have one carrier that you put most of your business with, and then guaranteed issue is probably gonna be another big chunk. Probably 25 to 30% of your business is going to be guaranteed issue, and then the rest is going to be your other secondary carriers that are going to cover some of those other conditions that are genuinely in the best interest of the consumer, okay? Now, when this happens, what you have to be mindful of is the comp cuts that happen, okay? So when you're getting paid with these carriers, right, this one's probably at that 120 rate, this one's probably maybe a couple points below that, this one's probably a little bit higher than that, and then you're probably at AIG, you're probably making maybe 80 points on this contract, okay? For most of you guys that are individuals, you're probably making 80 points on this contract. And if you're only making 80% on this business, you also have to think about the advances, okay? Final expense is a very advance heavy business, you guys. So when you write a policy, you're not just getting paid all that premium up front that they spend for the year. You're getting a certain amount advance. So probably with these carriers, you're probably at a 9-month advance, okay? This carrier, your guaranteed issue carrier, you're at a 6-month advance, okay? And then you need to know whether or not you're getting paid on issue or if you're getting paid on draft. That really, really matters, you guys. Because if you're getting paid on issue, you're gonna get cash flowed in 48 hours. But if you're getting paid on draft, especially if you're post-dating policies, and all post-dating means is, let's say today is the 5th of the month or the 10th of the month. Let's say the 10th of the month, right? And let's say your customer gets their income on the 1st or the 3rd of every month. You're gonna post-date that policy for the following month on that date that they're gonna get paid. So if that's gonna get paid on draft, they're not paying today, they're gonna pay when that policy is supposed to draft next month. And that means you have to wait 3 weeks before you're able to capture that income and actually get paid, which is a long time. So you really wanna understand the contracts to know if you're gonna get paid on issue, are you gonna get paid on draft, are you gonna get paid as earned, or are you gonna be able to participate in advances? Because that stuff really matters, especially in the economics of this business. Now, going back to underwriting, okay? So you hear the core 4 breakdown as far as what carriers you should have in the mix and understanding what those carriers are designed and used to do. Underwriting is a game of understanding formularies. When the insurance companies are actually doing the underwriting of the consumer, all they're really doing is pulling up their MIB report and they're doing a prescription check, okay? They're seeing all the medications that consumer has ever been prescribed. Doesn't matter if they've ever got the medications filled, if they've ever taken them, none of that matters. Have they ever been prescribed a medication? That's what you need to know when you're talking to these consumers. What medications have they ever been prescribed? Because based off of the medications, you want to know all of the medications for all of these carriers. Guaranteed issue, obviously it doesn't matter, but that is like worst case scenario, no other carrier would take them, you put them in that situation. But in most situations, they're going to have medications that fall within the parameters of your core carriers. And if you understand the medications for the carriers that you're writing and what they will actually classify those medications as in terms of whether it will be level, graded, or modified, you will know where they're best placed to go, okay? And certain things look certain ways to different people, right? So if someone has COPD and emphysema, Prosperity may not give them the best rate and the best price for that condition. But this carrier will probably beat that rate by maybe 30 or 40%, which is way better for the consumer, gives them better coverage, is a little bit faster coverage, is better all around for everybody. And you're really putting the consumer in the best situation. The reason why persistency becomes such an issue is because people are chasing commissions and then they're getting price beat when consumers are shopping in the market. And that causes a lot of issues. Now, once you understand all of the underwriting, this is where the conversation changes from being a bunch of sales tactics and trying to finesse the consumer to really understanding them and guiding them in the right way, okay? And you really sound very competent where you can talk to them about their different medications, what they're actually taking, how you can actually put them in a better situation, how certain carriers look at things one way versus another. Like that stuff really changes the game when you're having conversations with people. So you really want to make sure that you dial in the underwriting, okay? Your underwriting needs to align with the core 4 carriers that you're gonna be doing business with, okay? Because if the underwriting is aligned, this will always line up and these ratios will usually back out to all be where you need them to be, okay? Now, this brings us to our next point, which is our CPA. Now, I've heard a couple people on some crazy calls and we gotta call this out, you guys, because CPA is not what you spend per lead. Okay, this is how much you spend to acquire a customer. And you gotta understand how the entire ecosystem works. So no matter where you're probably getting calls, leads, traffic, whatever you're getting, there's a cost per lead, okay? That is what we call a CPL, okay? That's your cost per lead. And for the sake of round numbers, let's use $10. Okay, let's say you're spending $10 right now per lead. What you have to figure out is how many leads does it take to convert in a sale. And I'll tell you guys this. You guys, if you haven't turned your business into an equation yet, you're genuinely set up to fail. So when we're breaking down our CPL, which is genuinely our cost per lead, what we want to do is turn the business into an equation, okay? What you need to figure out is how many leads does it take to acquire a customer? And this needs to be a mathematical equation. So if you see your ratios at 1 in 10, right? So for every 10 people that raise their hand and say they're interested, right? How many of those people actually convert into a sale? This isn't how many people you talk to. This is how many people raise their hand and said they're interested before you get to a sale. So if you're at 1 in 10, for example, you're gonna times this number by 10, and this becomes your customer acquisition cost. You spent $100 to acquire a customer, right? Now, when you think about your cost per lead and you think about your CPA, it has to be in line with what the value of that customer is, okay? So if you set unrealistic targets, for the sake of final expense, this is a low, but it is achievable target, right? To be at $100. More realistically, most advertisers probably sit between $200 and $250 per acquisition, okay? That's just what the range is. Now, this would assume instead of you converting 1 in 10, you're converting 1 in 20, okay? Or you're still converting 1 in 10, but instead of $10 a lead, you're paying $20 a lead, okay? And this is how the math starts to change, and it'll fluctuate depending on how you're actually operating. So this is the range that you'll end up being in, 200 to 250. Then what matters is how much does the customer actually pay? And this is how we calculate our annual premium. So let's say the consumer is spending, for the sake of round numbers, $100 a month, right? They're spending $100 a month. If they're spending $100 a month on their insurance, we're going to times that by 12. That gives us our annual premium, and that is where we get to $1,200, okay? Now, this is what our AP is. Now we have to take this number and we have to times it by this 120. So you're not just making $1,200, now you're making, what is that, $1,440? So you're making $1,440 if you factor in the 120% contract. You're making $1,440, all right? That is what the commission would annualize at. And then you have to times that by your advance, okay? And this tells you how much money you're gonna get up front. So if you write it with these top carriers, you're gonna get a 9-month advance. And if you get a 9-month advance, now you just have to times this by 0.75. What is that math? Let me get your math on this. 1,440 times 0.75. You're at 1,080, okay? So you're getting $1,080 advanced to you up front. Now, based off of this math, this is where your customer acquisition cost is 10% of what you're making, right? In reality, if you're sitting closer to this number, your customer acquisition cost is a quarter of what you're making. To be a healthy business, especially in the insurance space, your customer acquisition cost needs to be a third of what your annual premium actually will back out into, okay? It could be no more than 30%. Yeah, no more than 30%. If it's over 30%, you're underwater very, very quickly because you haven't factored in the next most important thing, which is the persistency. Okay, so it's not just running the business, it's keeping the business. And persistency varies depending on what media channels you're using, also how you're servicing your business. But on average for telesales, most people realistically are sitting around 65%, 70%, you know, if you're doing good on telesales. And let's use the good numbers and let's just say it's 70%. So what this means, if you're at a 70% persistency, out of every 10 policies you write, 3 of them are gonna fall off, okay? That means those customers are gonna cancel, they're gonna lapse, they're gonna change their bank accounts, they're gonna run away, you're never gonna see them again. But this is what that number is. You gotta factor that in because this contributes to that other issue that we discussed at the beginning, where people have too many carriers, where instead of writing this carrier because one of those customers fell off, they try to write this carrier, and then they avoid the debt here, and then it just continues to pile up. The more you stay consistent, keeping this spread of distribution healthy across all your business, the cash flow is going to stay consistent. But I will tell everybody, final expense is a compounding business, okay? You will never be able to slow down once you get started. That'll be the new baseline, okay? And your first 3 months will be the most profitable for you before you really start to feel the effects of the persistency starting to catch up with your book. So as you're starting to make money early, make sure that you're saving some, putting some to the side, and making sure that you follow the basic principles of just money management, okay? Make sure you're managing your money. But the one thing that you always have to fund is your customer acquisition, okay? Depending on whatever your monthly production target is, you're going to literally figure out what your customer acquisition target is, and you're going to times that number by how many sales it takes to get to that target that you outline, and that becomes the math. And then you need to get as many leads as it takes to acquire those customers, and you need to just flow in the engine and just let everything work for you the way that it's supposed to. I hope this provides you guys a lot of context as far as what I think everybody needs to understand initially getting started. If you guys have any questions, drop them in the comments below. You guys could also reach out directly. Any way that we could help you guys within this ecosystem, let us know. But I want everybody to be successful, and I see a lot of people struggling with these 3 things, and I just wanted you guys to hear this message. Take care, everybody.